All right, let's get right into it. When you think about investing, your mind might jump to fast growth or maybe some high-risk bets. But what if there was a strategy that focused on something, well, more fundamental, something a little more durable? Today, we're going to break down an approach called quality investing, and we'll do it by looking at the new SBI Quality Fund. Think about your morning coffee for a second. You could have a giant, watery mug of instant coffee, or you could have a smaller, perfectly brewed cup made from really high-end beans. The whole experience, right? The aroma, the taste, the value you get from it is just on a completely different level. This idea that quality can often beat sheer quantity is exactly the principle we're diving into today. So to make sure we cover all the bases, we're going to tackle 4 big questions. First up, what in the world is quality investing? Then, why would you even choose this strategy over others? After that, we'll look at how this specific fund actually works. And finally, we'll cover the key details to help you figure out if this is something that might fit with your own goals. Okay, let's start with that first big question. What are we really talking about when we use the term quality investing? So, at its heart, quality investing is not about chasing the hot new thing. It's about finding and investing in companies that are just fundamentally solid. The cricket analogy here is perfect. Imagine you're building a team and you fill it with top-class batsmen. These aren't the players who just hit a 6 on an easy pitch. These are the ones who are consistent, reliable, and just really tough to get out, no matter what the conditions are. That's a quality company. So what do these star players of the business world look like? Well, there are a few key things fund managers are on the lookout for. A big one is a durable economic moat. That's just a fancy way of saying a strong, sustainable competitive advantage, like a brand everyone trusts, or a network that gets more valuable as more people use it. They also want to see high profitability, not a lot of debt, really stable earnings, and a big market to operate in. It's basically a recipe for resilience. Okay, so the idea sounds pretty good, right? But the real question is, what about the results? Let's take a look at how this strategy has actually performed and why someone might pick this path.
Let's just start with one number that really makes you stop and think. 30.62. Over a 20-year period, this is the kind of growth an index focused on these quality companies delivered. We're talking more than 30 times the initial investment. That really speaks volumes about the long-term potential here.
Now that number is huge, but this chart is where it gets really interesting, because context is everything. Check this out. If you'd put 1 lakh rupees into the broad Nifty 50 index back in 2005, you'd have over 16 lakh rupees today. And hey, that's a fantastic return. But if you'd put that same 1 lakh into the Quality 30 index, it would have grown to over 30 lakh rupees. That really paints a clear picture of the potential outperformance we're talking about. So here's the kicker. It's not just about the potential for those higher returns. Historically, quality stocks have also tended to be less volatile, especially when the market gets rocky, like during the global financial crisis or that COVID crash. They tend to fall less than everything else. So you get this incredible combination of offense and defense. Stronger returns with, you could say, relatively better peace of mind. Which brings us to the how. How does a fund like the SBI Quality Fund actually go about finding these companies? What's the process?
Well, it's a very disciplined process, almost like a funnel. They start with this huge universe of about 450 stocks. The first step is a number screen. They filter for things like high return on equity, low debt, stable earnings. But numbers only tell you so much, right? So the next step is absolutely crucial, a qualitative screen. This is where the analysts really dig in and assess those economic moats and the quality of a company's leadership. Only after all that does the final portfolio get built.
And this is a perfect example of why that human element, active management, is so important. Back in 2017, if you just ran a computer screen on Bharti Airtel, it probably would have been rejected based on its financials. But a sharp analyst could see the real story, the huge network, the massive customer base, that incredible moat. They saw the potential. And sure enough, as the telecom industry consolidated, Airtel's strength shone through and the stock took off. That's something a simple algorithm might have missed. All right, last section. Let's get down to the brass tacks. What are the practical details you need to know if you're actually thinking about this fund? The objective here is pretty clear: long-term capital growth. Now, this is a new fund offer, or NFO, which means it's the first time it's open to the public. That period runs from January 28th to February 11th, 2026. The minimum you can invest is 5,000 rupees. And one important thing to be aware of is the exit load. If you pull your money out within the first 6 months, there's a 1% charge. Okay, and this is absolutely crucial. While the entire strategy is built around finding stable, quality companies, we have to remember this is still an equity fund. It invests in the stock market. And according to the official riskometer, this scheme is categorized as very high risk. It's really important to understand that and make sure it lines up with your own comfort level with risk before making any decisions.
So that wraps up our breakdown. We've talked about what quality investing is, we've seen the kind of performance it can deliver, and we've looked at the process behind the fund. Which really just leaves one final question for you to think about. In a world that's filled with constant market noise, could a disciplined, long-term focus on quality be the right strategy for your portfolio?